6 years, not five, not four, six consecutive years, where the world has consumed more silver than the earth has produced. And in 2026, that number is not shrinking. It is 46.3 million ounces in the hole. The mainstream media calls it a commodity trade, a nervous investor's play. But what if what they are not telling you is the part that actually matters? Because buried inside a report released quietly on April 14th, 2026, is a number so structurally dangerous that it should be rattling every single trading desk on this planet. And almost nobody is talking about it. Why? Welcome to Financial Crisis Explained, the one place on the internet where we do not dress up danger in comfortable language. Now, before we go any further, and I say this with full respect, if you are the kind of person who has lived long enough to watch markets rise and watch them fall, who has seen promises made and quietly broken, then you already know that the most expensive thing in the world is information that arrives too late. So do yourself one favor today, the same favor you would tell your younger self. Hit that subscribe button, not for us, for you, because what we cover on this channel does not wait for anyone, and neither does the market. And before we begin, drop a comment right now. Where in the world are you watching this from? Whether you are in New York or Karachi, London, or Lagos, Dubai, or Delhi, we want to know who is in the room, because the story we are about to tell you today affects every single one of you equally. Now let us get into it. April 14th, 2026, a Monday morning. While most of the financial world was focused on equity markets, interest rate speculation, and the latest headlines cycling through Bloomberg terminals, the Silver Institute quietly released its annual World Silver Survey. No press conference, no breaking news alert, no primetime coverage, just a document, a precisely worded, data-dense document. That landed on the desks of a very small number of analysts and was almost immediately ignored. That was a mistake, because buried inside that report was a number that does not belong in a market that the mainstream calls stable. 46.3 million troy ounces. That is the projected silver deficit for 2026. Not a rounding error, not a statistical footnote, a structural hole 46.3 million ounces deep. But here's what makes this number genuinely alarming. It is not new. This is not the first year the world has consumed more silver than it has produced. It is not the second. It is not even the fourth. 2026 marks the sixth consecutive year of structural silver deficit, 6 years running. 6 years where global industrial demand, investment demand, and monetary demand have collectively outpaced every mine, every recycling operation, every above-ground stockpile draw on the entire planet. To put that into a context that serious decision makers can actually feel, the cumulative drawdown across these 6 years is now equivalent to approximately 1 full year of global silver mine production, consumed, drawn down from above ground inventories, gone, and the world is still short 46.3 million ounces more in 2026 alone. Now, at this point, a reasonable person might ask a very straightforward question. If silver has been in deficit for 6 straight years, why has the price not reflected that reality? That is precisely the right question. And the answer to that question is what separates a surface-level commodity analysis from a genuine understanding of how this market actually functions. But before we get there, we need to establish exactly what this deficit number means in physical terms. Because numbers without context are just noise. 1 troy ounce of silver weighs approximately 31.1 grams. 46.3 million troy ounces is roughly 1,240 metric tons of silver. To visualize that, imagine filling more than 14 fully loaded Boeing 747 cargo aircraft. Floor to ceiling, wing to wing, with nothing but silver. That is the volume the world needs in 2026 that does not currently exist in accessible supply. And this is not silver sitting in a vault somewhere, waiting to be unlocked by the right price signal. This is silver that has already been consumed by industrial processes, already embedded inside solar panels, already integrated into semiconductors and medical devices, already gone from the above-ground supply chain permanently. The Silver Institute's methodology is not speculative. Their demand figures are compiled from industrial consumption data, government import and export records, manufacturer purchasing reports, and direct consultation with the largest silver-consuming industries on the planet. When they project a 46.3 million ounce deficit, they are not estimating sentiment. They are counting physical inventory against physical demand. And the inventory is losing. What makes this structural rather than cyclical is a distinction that most retail financial commentary completely fails to draw. A cyclical deficit corrects itself. Prices rise, miners expand, production demand softens, balance is restored. That is how commodity markets are supposed to behave. A structural deficit operates by entirely different rules. It persists not because the market is slow to respond, but because the underlying supply and demand forces are mechanically locked. Mine production cannot be scaled quickly. Silver mines take 7 to 10 years from discovery to meaningful production output, and industrial demand, driven by the global green energy transition, is not softening. It is accelerating, which means the gap between what the earth produces and what the world consumes is not closing. It is widening. 6 years of deficit, 1,240 metric tons short in 2026 alone, a supply pipeline that cannot respond in time, and a price mechanism that has not yet told the truth about any of it. This is not a commodity story. This is a structural crisis unfolding in slow motion. And we are only getting started. Imagine walking into a car dealership. The showroom is polished. The salesman is confident. The brochures are perfect. You select your car, sign the paperwork, hand over your money. And then the salesman leans forward and quietly says, "The car does not actually exist. But the price we charged you was completely real." That is not a hypothetical scenario. That is not a metaphor borrowed from fiction. That is the precise mechanical description of how the silver market has been pricing a physical commodity for decades. Here is what the mainstream never explains. When you see a silver price flash across your screen, that number is not being set by people trading physical silver. It is being set by people trading paper, futures contracts, options positions, synthetic derivatives, financial instruments that represent silver but are backed by almost none. The London Bullion Market Association, the COMEX Futures Exchange in New York, these are the two primary venues where silver's daily price is discovered, and both operate on a system that allows the same physical ounce of silver to be sold and sold again dozens of times over to dozens of different buyers simultaneously, without that silver ever moving, without that silver ever being verified, without that silver in many cases even existing. The leverage ratio inside the COMEX silver market at certain points in recent history has exceeded 300 to 1. 300 paper ounces sold and traded and repriced for every single physical ounce that actually exists in the vault. Let that number settle for a moment. 300 to 1. In any other financial context, that ratio would trigger emergency regulatory intervention. It would be headline news. It would be called what it actually is: a systemic risk of extraordinary magnitude. But in the silver market, it is called standard practice. Now, here is where it gets structurally dangerous. The paper market system functions only under one critical assumption: that the overwhelming majority of contract holders will never demand physical delivery. They will roll their contracts, take their cash settlement, and walk away satisfied. And for most of modern financial history, that assumption held, because most silver market participants were speculators, hedge funds, momentum traders, institutions playing a price movement, not entities that needed the physical metal in their hands, in their facilities, in their supply chain. But that participant profile is changing. The green energy transition has introduced a new class of silver buyer, one that the paper market architecture was never designed to accommodate. Solar panel manufacturers in China, electric vehicle battery producers in Germany, semiconductor fabricators in Taiwan and South Korea. These are not speculators. These are industrial consumers. And industrial consumers do not roll contracts. They do not accept cash settlement. They do not care about paper price discovery. They need physical silver delivered to a physical facility on a physical timeline, because without it, their production lines stop. And this is precisely where the illusion begins to crack. When an industrial consumer submits a delivery notice on a COMEX futures contract, the system is forced to locate and transfer actual physical metal, not a promise, not a synthetic equivalent, physical silver. And in a market running a 46.3 million ounce annual deficit, in a market where above ground stockpiles have been drawn down for 6 consecutive years, that request becomes increasingly difficult to fulfill. The mainstream financial media frames silver's muted price response as evidence that the deficit is manageable, as proof that the market is functioning normally. But what it actually represents is the last stage of a paper suppression mechanism that is running out of physical silver to suppress with, when the paper can no longer substitute for the physical, when industrial delivery demands exceed what the vaults can provide. The price does not adjust gradually. It does not signal politely. It dislocates suddenly, violently, and without warning to those who were not paying attention. 6 years of deficit, a paper market leveraged 300 to 1, industrial consumers who cannot accept substitutes, and a mainstream narrative that has not told the truth about any of it. The illusion is not cracking, it is already broken. The only question that remains is how many people will understand that before the market makes it impossible to ignore. Continue to part 3, where industrial demand locks the trap permanently. There is a question that almost nobody in the mainstream financial media is asking, and it is the most important question in this entire story. What happens when the world's most electrically conductive metal becomes structurally impossible to replace inside the industries that are building the future? Not difficult to replace, not expensive to replace, impossible, because that is not a hypothetical scenario sitting somewhere in the distant future. That is the precise situation the global industrial economy is navigating right now in 2026. Silver is not gold. That distinction matters enormously, and it is almost universally misunderstood. Gold is primarily a monetary and investment metal. Approximately 85% of annual gold demand comes from jewelry, central bank reserves, and investment vehicles. Remove investor sentiment from the gold market and the price corrects. Silver does not work that way. Approximately 60% of annual silver demand is industrial. It is consumed inside products. It is processed inside manufacturing facilities. It is embedded inside technologies that the global economy has already committed to deploying at a scale that has no historical precedent. Remove investor sentiment from the silver market entirely, and the deficit does not shrink. It barely moves. Here is why. Silver possesses a combination of physical properties that no other element on the periodic table replicates. It is the most electrically conductive metal known to science. It is the most thermally conductive metal known to science. It has natural antibacterial properties that make it irreplaceable in medical applications. And it reflects approximately 95% of visible light, making it the foundational material in solar energy capture. These are not marketing claims. These are physical laws. And physical laws do not respond to price signals. They do not negotiate with supply chain managers. They do not care about deficit reports or analyst forecasts. When a solar panel manufacturer needs silver, there is no column B. There is no alternative material waiting in a laboratory somewhere that performs the same function at scale. There is silver or there is no panel. Now consider what the global green energy transition actually demands from silver supply. A single solar panel contains approximately 20 milligrams of silver per cell. A standard residential solar installation contains dozens of panels. A utility-scale solar farm contains thousands. The International Energy Agency projects that solar capacity must triple globally by 2030 to meet existing climate commitments made by governments across 4 continents. Triple, not grow modestly, not expand gradually, triple. and every megawatt of that solar capacity requires silver that must be mined, refined, and delivered before a single panel can generate a single watt of electricity. Then there is the electric vehicle industry. A modern electric vehicle contains between 25 and 50 grams of silver embedded across its electrical systems, battery management circuits, and charging infrastructure components. Global EV production in 2026 is projected to exceed 17 million vehicles. Run that arithmetic. 17 million vehicles at an average of 35 grams of silver each. That is approximately 595 metric tons of silver consumed by the EV industry alone in a single calendar year, from a market that is already 1,440 metric tons short. And then there is the sector that receives almost no attention in mainstream silver analysis: artificial intelligence infrastructure. Every data center being built to support the current AI expansion cycle requires silver-coated contacts, silver-based thermal interface materials, and silver-laden printed circuit boards. The AI infrastructure build-out currently underway across the United States, China, and the European Union represents one of the largest single concentrations of silver-consuming electronics manufacturing in human history, and it is accelerating, not plateauing, not slowing, accelerating. This is what makes the industrial demand equation so structurally unforgiving. It is not one industry pulling on silver supply. It is not two. It is solar, electric vehicles, artificial intelligence, semiconductors, medical technology, defense electronics, and water purification systems, all expanding simultaneously, all competing for silver from the same shrinking pool of above-ground inventory, all unable to substitute, delay, or negotiate their way around the physical requirement. The mainstream narrative frames this as a demand story, a bullish case for silver investors, a commodity trade with favorable fundamentals, but that framing is dangerously incomplete. This is not a demand story. This is a supply impossibility story. The demand is not the variable. The demand is locked. What is breaking down is the world's ability to physically supply what the demand has already contractually committed to consuming. 6 years of deficit, a paper market that cannot deliver physical silver at scale, and now an industrial demand base that is structurally incapable of consuming less. The trap is not closing, it is already closed. The only remaining question is when the market price finally reflects the reality that the physical supply chain has been living with for 6 consecutive years. Continue to part 4, where the dislocation event becomes impossible to contain. There is a word that professional traders use when a market stops behaving like a market. Not a correction, not a pullback, not a cycle reversal, dislocation. A dislocation is what happens when the price of something and the physical reality of that something diverge so completely, so structurally, that the mechanism connecting them simply breaks. And when that mechanism breaks, the adjustment does not happen over months. It does not happen over weeks. It happens in days, sometimes in hours. And the people who were not positioned before it happened discover very quickly that markets do not wait for understanding to catch up. History has shown this pattern before, and it is worth studying precisely because precision is what separates strategic decision-making from emotional reaction. Cast your mind back to the year 2000. Palladium, a metal used primarily in catalytic converters for gasoline-powered vehicles, a metal that had been in structural deficit for several consecutive years, a metal whose paper market had been absorbing the gap between supply and demand through lease arrangements, forward sales, and synthetic positions, until one morning Russian export supplies tightened without warning. The physical market could not source palladium at any price that the paper market had been advertising. In the space of approximately 14 months, palladium went from $300 per ounce to over $100 per ounce, a 267% move, not because investor sentiment shifted, not because a newsletter recommended it, because the physical supply was gone and the industrial consumers who needed it had no alternative. Then came nickel. March 2022, the London Metal Exchange, a metal in structural supply stress due to geopolitical disruption, a paper market carrying positions that had no physical backing at scale. When delivery pressure hit, nickel prices doubled in less than 48 hours. The London Metal Exchange was forced to halt trading entirely, to cancel billions of dollars worth of executed trades, to suspend the fundamental price discovery mechanism of one of the world's most important industrial metals, because the paper market had promised supply that the physical market could not deliver. Now return to silver in 2026, 6 consecutive years of structural deficit, above-ground inventories drawn down by the equivalent of 1 full year of global mine production, a paper market operating at leverage ratios that would be considered criminal in almost any other financial context, an industrial demand base that is not contracting, not plateauing, but accelerating across solar electric vehicles, artificial intelligence, infrastructure, and defense electronics simultaneously, and a mainstream financial media that is still, as of this moment, describing silver as a speculative commodity trade. The conditions for a dislocation event are not approaching, they are already assembled. What does a silver dislocation actually look like in practice? It does not begin with a headline. It does not begin with an analyst report or a central bank announcement. It begins quietly. It begins when a mid-sized solar manufacturer in Southeast Asia submits a physical delivery request and is offered a cash settlement instead. It begins when a semiconductor fabricator in South Korea attempts to purchase silver for forward delivery and finds the quoted premium has doubled overnight. It begins when COMEX registered silver inventories, the metal actually available for physical delivery, drop below a threshold that triggers institutional awareness. And then what was quiet becomes loud, very fast. For the business community watching this unfold, for the entrepreneurs and capital allocators who have stayed with this analysis through 4 parts. The strategic question is not whether a dislocation is coming. The structural evidence assembled across this video makes that question largely academic. The strategic question is, what does a rational decision maker do with this information? And the answer requires separating 3 distinct categories of response. The first category is awareness positioning, understanding that silver is not behaving like a traditional commodity, understanding that its price is currently being set by a paper mechanism that is structurally disconnected from physical supply reality. This means that conventional technical analysis, conventional commodity cycle frameworks, and conventional financial media commentary are not reliable navigation tools for what is coming. Decision makers who continue using those tools are reading a map of a road that no longer exists. The second category is supply chain exposure assessment. For any business operating in manufacturing, electronics, renewable energy, or advanced technology, the question is no longer whether silver prices will rise. The question is whether your supply agreements, your forward purchasing arrangements, and your inventory buffers are structured to survive a 200 to 300% price movement in a critical input material over a compressed time frame. Because palladium answered that question in 2000, nickel answered it in 2022, silver is assembling the same answer in 2026. The third category is capital allocation clarity, not financial advice, but structural clarity. When a physical commodity is in its 6th consecutive year of deficit, when the paper market masking that deficit is operating at leverage ratios with no physical foundation, when industrial demand is locked and accelerating across multiple simultaneous sectors, the question of where real capital is flowing answers itself. The institutions that understood palladium in 1999 were not lucky. They were simply paying attention to the same kind of structural evidence that is sitting in plain sight right now. 6 years of deficit, a paper market built on leverage that has no physical foundation, industrial demand that cannot contract, cannot substitute, and cannot wait. Historical precedents that have already shown exactly how this resolves, and a price mechanism that has not yet told the truth about any of it. The dislocation is not a prediction. It is not a forecast built on sentiment or speculation. It is the mathematically inevitable outcome of a physical reality that the paper market has been postponing for 6 consecutive years. The postponement is ending. The reckoning is not coming. It is already here. This was part 4 of Financial Crisis Explained.